Hey guys, welcome back to Dawn Investments. Today's just going to be a quick guide to, our safe trading strategy. I use this strategy and these tips on my regular account. These safe trading, the reward is slower, but you see results more often, better results, and over time, I even prefer this style of trading more than, buying breakouts, market open, more risky trades. But any way you trade is fine if you make profit. Stick to what you're best at, but this is just another way that I think safe trading can work. So this is just our overall to our safe trading strategy. It doesn't go too in depth in any one subject. So we're just gonna not quickly, but just give an overall on like the basis of the strategy, the basic parts of it. The first thing we're going to do, for those who don't understand, we're going to show how to, draw proper support and resistance lines, because that's a integral part of the strategy. For this one, we're going to use, I'll use TEVA as an example, because this is what I was looking at for the past couple of days, and it has nothing on it. A simple support and resistance line, for those of you that don't know, is just the support is the place where the stock is hitting that doesn't pass, and the resistance is the top where the stock hits that it has a hard time passing. The support is usually where stock bounces off of, and we use that as usually as a good entry points in our safe trading strategy. A support in this stock TEVA, we draw it right here at 1440. Some may ask why not 1430. I like to draw it at like a solid support where the solid body of the candlestick hits, not exactly where the tail end goes, because usually it doesn't go that far, but in some cases it does, which is where we'll get into stop losses a little later in the video. But yeah, so we'll draw a support right here, and this is where the bottom of the stock is, and where we want to enter around here. The trick is just knowing that is a good support, and a good entry point. A resistance for this stock is here at 15, 33, 34, or around the area. I'll just make it 35 because half numbers and whole numbers like 5 or 10, 15, stuff like that are usually natural resistances, maybe because of psychology or anything like that, but it's just more natural. Now, after you make a support and resistance, and know that there can be multiple resistances. Like there's another one here at 1586, 85, and once you make the support and resistance, this is where you see you make a plan. This is the beginning of our strategy. We make a plan. So if this was the beginning of the day or in pre-market or the night before when we do our homework, we would see, like if this was on Monday, well this is Friday, so we would have to wait till weekend. So if this was the next trading day, we would see this as a previous support and this is a resistance. We would try to get into entry here, around here, and if you get into entry here and get out at this resistance, you have a potential profit of 6%. And mind you, trading safe, 6% sounds low, but it is a safe margin versus, that 20%, those big wins that everybody wants. But, those are harder and involve a lot more risk that you may not be able to tolerate if depending on your case. So, here is our support. We try to get an entry here, but, realistically, it doesn't always happen exactly there. But once it hits support, what we look for is upward momentum, an uptrend. Or something of that nature. We base an uptrend off candlesticks. In our strategy, we use candlesticks. We look at these EMA lines and then the VWAP. We can get into those in another video if you want to know, or just ask me in the Discord or message me, and I'll try to make a video on it. But I won't get into that in this video. So we base it off the VWAP and EMAs. These lines, and then this dotted line is my VWAP. And we base it off candlesticks to see if it's an upward momentum going on. So to zoom in, right now this is a 5-minute chart. We look. So TV will hit a support, and based on this, it looks like it hit a hammer right here, then an inverted hammer on a downtrend. A hammer and an inverted hammer on a downtrend are both bullish signs, which is good. And then this looks like a bullish engulfing, the downtrend, the bearish candle right here, followed by a bullish green candle right here. It's called a bullish engulfing. These three signs right there, near a support with an increase in volume, are all signs of an uptrend. So this will be a signal for us to get in. And a good entry for us would be right here at the next green candle. Here is where we have to stay mentally prepared, because soon, as you can see, a red candle came up, and if we were trading this stock, we would have been scared with the red candle, but you have to stay strong. And this is where a stop loss is important. A stop loss is like a mental check. And we wouldn't sell it unless our stop loss hit. So we will hold this stock. Let me just get into it. So where we will put our stop loss, we will enter here at 555. This is what a regular trade, this is what our process is in a regular trade. Usually our stop loss is 2% away from our entry point. You can see that on this chart. This is 1%, as you can see, and then 2% is right here around 425. Usually we do 2%, but if we buy exactly at a support, we'll make it 2% off the support. 2%, depending on your risk, you can either do 2% off the support or 2% off your entry point. Our risk, depending on the higher price the stock is for us, the more of a risk the less of a risk we're willing to take. So for a stock priced over $10, we'll have a stop loss 2% away from our entry point, because these stocks usually don't see big spikes and movements like something that's versus $2 or something that's $1. Something that's $15 shouldn't see a spike, a drop in price of 4% so quickly. So we would set our stop loss away 2% from our entry point, just because if this stock had lowered off this entry to this point, being that it's above $10, that's a very bad sign, and we would want to cut our losses. But if it was, what we get into later, if it was a cheaper stock like $1 or $2, we would increase our risk tolerance a little bit, because of how volatile those stocks are compared to a stock that's $15. A stock that's $1 can drop 4% in a minute and then be up 10% in the next minute. But if you guys notice with experience, you'll see stocks like this usually won't do that. It's just a rare case that this seems like a lot, but this is a 5% loss, and this isn't something that is too common with stocks like this. So getting back to it, we would enter right here, and to be safe, in a safe trading strategy, we look at 1 to 3% as an easy goal to obtain. Like right here, we've made 1%, almost 2% gain, an optimal time to sell. You see a hanging man candlestick right here, an optimal time to sell. Or if you want more, which we find harder, 4 to like 7% is a little bit harder to achieve. So if you wait longer, you could have maybe reached it at this point right here. But see, we would never hold something for that long, because unless we're holding it for a swing. But in a day trade, something goes up right here, and then we see a bearish candle like this hanging man, we would most likely sell. But see, then it comes down and bounces off this VWAP. It consolidates off this VWAP right here. And that's also a sign that we use. Most of the time we use that as a bearish sign for us, just to be safe. In our safe trading strategy, we look at something bouncing off a support or bouncing at a specific level. We usually like to get out of those points. But in this case, it goes up. If something is bouncing off a VWAP specifically and is trading above the VWAP, it's actually a bullish sign. But if it would have broke this VWAP, we would have used this as a stop and have cut our losses. That brings me to my next point, where increasing your stop matters. once you have gotten to this point from here, if you're still in the trade, you won't want to keep your stop loss still this far away. So instead, you would increase your stop loss, and a VWAP is always a good support and resistance and a good place to set your stop at. So instead of keeping it, all the way down here, increase your stop loss and make it maybe 1% off the VWAP and sell out at this point. Because if this stock goes back to the here, 1% off the VWAP, and that is just a good place to cut our losses. So you could hold this stock, hope for the best, and then at that point it will go up. At that point it would go up, but instead, and in worst case scenario, if it breaks the VWAP, which is a very bearish sign and a bad sign, you should start getting ready to sell. And if it breaks the VWAP by 1%, then you would automatically sell out anyway. And that's how we basically calculate our stop loss, like a basic overview, and how we draw and use support and resistance lines. Okay, so with everything I said, this leads me to my next point, which is the criteria, the basic criteria we use to trade stocks. Now, see, the criteria we use, it's not set in stone, and we look at a lot of factors, but this is the basic criteria we use to make sure we're trading something that we see has potential. Never trade something that you don't think has potential, or trade something that's based off somebody else's opinion on whether it has potential. Make sure you analyze, like the way we're doing, and see if it has potential. Our criteria begins with volume, a volume spike. The average volume and a spike in volume is what we would use, our first indicator for what we use to jump in. As you can see on the side, TVA has around 22 million in volume right now. Anything over a million is good for us, but 22 million is even better. That means people are trading the stock, it'll move, and it has buyers and sellers, which is a good sign. And even the average volume being over 750K, something that you can, use in a screener or scanner, something on FinViz if you were looking at average volume. And a relative volume of around 1 is always ideal. The next thing we will look at is if, for an entry point as our criteria, if it's near a support. Here, like I said, we will buy here, which is near support, is only around 1% away from a support. On other stocks, there can be multiple supports, but for this one, just this example right here, this is 1% away from a support, and that meets our criteria. And then we will look at chart patterns. And as you can tell from earlier, we have the hammer, inverted hammer, and then a bullish engulfing. So it meets that criteria as well. Once we have all three of those criteria, then that's when we look for points of entry. And then we look at how far below it is from the EMA and the VWAP. And even and then we would buy it here, but even a safer bet would to see if it would break this VWAP, which it eventually did. And if you don't know, or if you're just not ready to buy at the point we bought, using the criteria and looking at the EMAs and VWAP, an even safer route to go, which may potentially be less rewarding, but a lot safer, is to buy here. Buy at the VWAP. The VWAP was 472, or at that point it was 466. If you would have bought it here at the VWAP as it broke, you would have bought around 417, and you set your stop loss away. Remember, 2%, 2 to 3% around away from your VWAP. Just make it 2.5. The stop loss to $14.29. With that type of risk and away from the VWAP, you would have had a potential profit of 4.63%. So with a VWAP, buying at the VWAP is always a good option, because the VWAP is a point where you can use the support, resistance, buy point, an entry point, and a sell point. The VWAP has a lot of functions, and you should definitely include it on your chart. for analysis. So yeah, so after you use the criteria and you look at the EMAs and VWAP, and let's say you buy the VWAP, and you buy that VWAP breakout, just set your stop loss 2 to 3% away. Wait for it to go, because at that point you're managing risk. 2%, of, let's say you're trading with a small account, with $100, 2%, you're barely losing anything. And or if you're trading with a big account, $1,000 for example, you lose $20, but you have the chance to make 40. So for some people that may not be worth it, making $40 for a risk of 20. Some people may want to look for more. It's all up to you. This is a 2-to-1 ratio, or you can look for ratios 5-to-1 or anything like that. It's all dependent on what your goals is and how much you want to make. But for trading and safe trading, I would always say go for 1 to 3% profit gain, because anything can happen with the stock market, and a 3% gain is better than a loss. And for my final tip for our safe trading strategy is base your risk tolerance on the amount of money in your account. For example, with this again, if you have $100 in your account and you set a stop loss at 2.5%, but I want to add to this as you should base your risk tolerance off what you have in your account, but also base it off the price of the stock. With something like that moves slow, you can tell if it moves slow by its price, and looking at its ATR. You can find that on scanners and stuff like that. It'll show you an ATR. ATR basically just tells you what's the range of movement. It moves during one day. It'll tell you like 10 cents. It moves up 10 cents or 20 cents in a day. But for more expensive stocks, setting 2%, it wouldn't drop that much. But see, with TIVA, it does. But for lower account, setting your stop at 2%, for me, in our opinion, a lower account with setting a stop at 2%, you only lose $2. And trading a very volatile stock, let's say a lower price stock, let's look at like MNKD, a lower price stock. Okay, so with MNKD, for example, if you set your stop loss at 2% with a lower price stock that's very volatile like MNKD here, let's say you bought it right here at 533 and your stop loss is 2% away, you would have got stopped out on this real quick run because it's so volatile. It'll go down 2% very easily, and you would have lost $3, or plus whatever commission you're charging if you're not using Robinhood. Or you can increase your risk tolerance with these lower price stocks and make it something around, for us we make it 6 to 8% risk tolerance with lower price stocks, because we're willing, especially when we have small accounts, we're willing to lose that. For example, with the $100 account, we're willing to lose that $6 to $8 for a potential run. If a lower price stock drops 8%, that's a bad sign. But if a lower price stock drops 2%, that's not really a bad sign, because as you can see, right after it dropped 3%, it shot up almost 10% in the next couple minutes. So with the more volatile the stock you're trading, the more of a risk tolerance you should be willing to take. You shouldn't keep your risk tolerance low trading a volatile stock like it's like some of these lower stocks. The risk tolerance of 2%, it should be more so for more expensive stocks and maybe for more expensive accounts that you're not willing to lose that much money. If you're trading a $1,000 stock, it'll hurt a lot more losing $30 versus you losing $3 with a $100 account. And that's just our tip and how we handle and how we trade cheap stocks with a low account versus expensive stocks. And that's just how we handle that. So taking this into a realistic scenario, this is what I traded. I swung for, this is what I swung for today and made a quick $90 profit with my regular account. We bought it the previous day. This is today. We bought it the previous day on a quick downtrend. We bought it here because we saw the hammer. Then we saw this bullish engulfing, and then we saw another big bullish candle. So we bought it here, like in the middle of this spike, around 10:55. We held it for multiple days because it's been on an uptrend. As you can see, it's been on an uptrend since its 52-week low. So we didn't expect it to come back down to this level since it's just, it's been climbing. And let me show you this is the 181 hour chart. It already hit the 52-week low, so we expected it with support and resistance lines, like we showed you before. We expected it to rally back. These are two resistance. This is a resistance, and this is a resistance, and this is a support. It hit this support. We saw that. We saw it here this day, and we expected. This is a potential profit of 27%, but we only want to trade it to this day, yesterday. So this is a potential profit of 14% to its resistance, and we saw that. So we wanted to take advantage. So then we looked at our criteria, like I mentioned earlier. Looked at our criteria. It has volume, 15 million. We looked down at it, and we saw the volume. We saw it wasn't near the original 968 support, but it was near its own separate. It was on a smaller, less strong support right here. And this is a resistance. You could use old resistances as new supports. It was close to that support right here, and it was trading off using the EMAs as a support as it was climbing. When the EMAs is moving up with the stock, that's a great sign. So it was moving up with the EMAs, bouncing off the supports, and then we saw the chart pattern. So it met all our criterias. It bounced down. It bounced down here, and with the chart patterns and the rules, we bought it here. And since it's been on an uptrend for the past couple of days, we took the risk and held it overnight, and it began to climb. We sold it because what we were looking for in our regular account, we don't trade risky. We look for safe return, and overnight it already went up 5%, which is more than what we look for, and we decided to sell for a quick 5% gain. And that's basically how we utilize all those strategies we just showed you to support resistance, candlesticks, and chart patterns, and all that just for a regular trade. Oh, and let me show you how we manage the stop loss. So for this, we had our stop loss at this support right here. We bought it here. We had a stop loss, like I said, 2 to 3% away, and it just happened to be a support. So we made a little bit less than support because, sometimes the shadow candle could pass the support, but we made it just a little bit less. So we had our stop loss at 220, actually down here. And it was it was a little much, but we were willing to take it. And luckily it didn't even get to that point. And it grew, and we sold for a profit. And that's how you use all our tips and tricks, and that's how you use all of them to trade a regular stock in a very safe way and a reliable way. That was safe because at the end of the day, even if worst case scenario, it would have came down as a support, we would have noticed it if it came down to support. And if it showed that it was on a strong decline, we would have sold it here. And then even if we didn't happen to sell, it would have hit our stop loss a couple cents away, and we would have lost maybe near maybe like $50, and we were fine with that. But it was a potential profit of 90, and that's what we made. So yeah, we made the potential profit, and if we would have hit the stop loss, we would have lost around maybe like $40 to $50 with trading with 2,000. We would have lost around $40 to $50 with this stop loss, and we were willing to take that because we saw the profit was worth the profit in all the indicators. We believed it was worth the risk, and that's how we use our criteria. And hopefully this worked. If you have any questions or want me to go more in depth in any aspect of this video, just let me know, and I'll be happy to do that. Thanks for watching.